market participants try to manipulate the price in a number of different ways. Wash trading is one of the most popular types of trading. The Commodity Exchange Act, CEA, and the Securities Exchange Act of 1934 initially barred round-trip trading, a type of market manipulation. In this video, let's explore the subject of wash trading in depth to learn what constitutes a wash trading, how it works, and how do you identify wash trades. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. So, watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So, let's begin the video. What is wash trading? Wash trading is a type of illicit trading in which a trader simultaneously buys and sells the same security investment. This indicates that purchasing the same security nullifies selling it. Due to the fact that the investor's portfolios contain shares of the same security, this type of trading is known as round-trip trading. The main purpose of this type of market manipulation is to try to affect pricing or trade activity. Investors try to increase buying activity to push prices up or decrease selling activity to drive prices down by buying and selling the same securities. Brokers and investors may occasionally collaborate to affect trading volume in a way that is advantageous to both parties. For instance, the broker might profit from commissions paid by other investors who wish to buy a stock, security, or cryptocurrency that is the subject of wash trading. By gaining from the sale of securities by manipulating the price, the investor may also profit. Many professionals believe it to be insider trading. After the Commodity Exchange Act was passed in 1936, the federal government in the U.S. initially outlawed it. Before this, stock manipulators utilized wash trading to inflate the value of a stock by faking interest in it. This made it possible for manipulators to profit by selling the stock short. Wash trading in the cryptocurrency market. The cryptocurrency market has also seen instances of wash trading in recent years. Numerous cryptocurrency startups are obviously making an effort to appear popular and have big trade volumes. Even the most well-known cryptocurrencies, like Bitcoin, have been impacted by this. It is not just limited to low-cap coins. The existence of wash trading in the cryptocurrency industry is due to a number of factors. There are no widely acknowledged techniques for calculating daily trade volume for major currencies like Bitcoin. Because of this, cryptocurrency companies frequently produce contrasting data for previous trade volumes. In recent years, there have been numerous high-profile public token exchange breakdowns, which serves as evidence that many cryptocurrency exchanges are unreliable. Extreme volatility in the cryptocurrency market also encourages quick buys and sells. The ambiguous position of cryptocurrency with U.S. and other national regulations creates additional potential. If you are still watching this video, don't forget to hit the like button and share your thoughts in the comment section below. If you haven't subscribed to the channel yet, please subscribe, as that motivates us to bring more videos like this for you. How does wash trading work? There are typically two requirements that must be satisfied for a wash trade to exist. Intent. At least one of the parties, the broker or the investor, must have engaged into the transactions with that goal. Result. For accounts with the same or common beneficial ownership, the outcome must be a wash trade in which the investors acquired and sold the same asset in a brief period of time. Accounts that belong to the same person or entity are referred to as having beneficial ownership in this context. Financial regulators may take notice of accountants with shared beneficial ownership if they detect wash trading. If a trade doesn't alter the security's overall market position or expose it to market risk, it may be a symptom of wash trading. They can happen if investors and traders appear to conduct a trade on paper without any assets really changing hands. They do not necessarily include actual trades. How do you identify it? Firms and regulatory bodies seek for irregular or aberrant trading patterns among traders to spot wash trading. Any activity that doesn't affect the entity's profit or loss, like purchasing and selling quickly, is noted. Only thorough trade surveillance can allow a company to find it. When a company learns of a situation like this, it must notify the regulator as quickly as feasible. Additionally, it shall take the required legal action to make up for any harm that the activities have brought about. It has to assess its compliance strategy to determine if any flaws allowed wash trading to happen. Share your thoughts in the comment section below to let us know. See you in the next video. Until then, take care and stay fit in health and wealth.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.